Hello, friends, and welcome back. I hope you are sitting down for this one. Listen closely, because what I am about to tell you is not a theory, and it is certainly not a drill. They passed it. The new banking rule starts Monday, and most people have absolutely no idea what is coming. While the retail public was distracted by political noise and stock market charts, the real decision was made behind closed doors in Basel, Switzerland. The Bank for International Settlements, known as the BIS, the central bank of all central banks, has officially passed the final implementation phase of the Basel Three endgame rules. This is not a rumor on the internet. This is a regulatory mandate that goes into full effect the moment the markets open on Monday morning. They passed it quietly because they know it changes everything about how our financial system works. This new rule forces the biggest banks in the world to completely revalue how they hold gold and silver on their balance sheets. For decades, paper contracts were treated as if they were as good as gold. Starting Monday, that lie ends. I want to pause here and ask you a serious question. Do you trust these big banks to tell you the truth when your savings are on the line? Let me know in the comments, yes or no. Because frankly, looking at their track record, I think we all know the answer. To understand why this matters to your retirement, you have to understand bank capital requirements. Before today, banks could hold unallocated gold and silver, which are essentially just paper promises, and count them as a safe asset. The new rule changes something called the net stable funding ratio. It makes holding unallocated paper metal expensive and incredibly risky for the bank. It penalizes them for holding short positions. This forces banks to make a choice, either buy physical metal to back their positions or exit the paper market entirely. They passed this rule to prevent another 2008 crisis. But in doing so, they have lit the fuse for a precious metals explosion unlike anything we have ever seen. This rule is the final nail in the coffin for the naked short selling that has suppressed the price of silver for 40 years. Institutions like JP Morgan and Citi can no longer hold billions in short positions without holding massive amounts of capital against them. It simply becomes too expensive to manipulate the price. The cost of carrying those trades has just skyrocketed. We are already seeing banks unwinding their short positions in the overnight markets just to comply with the deadline coming this Monday. This buying pressure is what will drive the price up. It is not speculation, it is regulatory compliance. Previously, gold was considered a risky asset, just like a stock. Now it is considered risk-free capital, just like cash or treasuries. And this fundamental shift in strategy explains exactly what we are seeing in the market mechanics right now. When the banks switch from being sellers to being buyers, the price floor rises permanently. This explains the liquidity vacuum we saw just last week. The banks withdrew their sell orders because they knew this rule was coming. They did not want to be caught short when the new regulations kicked in. The market halted not because of a glitch, but because the market makers were stepping back to recalibrate their algorithms for the new Basel Three reality. The game has changed from suppress the price to secure the asset. Industrial users like Tesla and Samsung are also painfully aware of this rule change. They know that if banks stop selling paper silver, the price will rise to meet the true physical demand. This is why we are seeing panic buying in the industrial sector right now. It is a race between the factories and the banks, and I can tell you, there is not enough silver for both. China has been compliant with these rules for months. The Shanghai Gold Exchange operates on a fully allocated physical basis. The West is just playing catch-up. This rule change is effectively an admission that the Chinese model of physical assets won over the Western model of paper assets. By passing this rule, Western regulators are aligning with the East. They are admitting that paper derivatives are dangerous and physical metal is the only true safety. Sound off in the comments below. Do you think the US dollar can survive this shift as the world moves back to gold? I want to read your theories on this. So why should you care? Because while this rule makes the banking system safer in the long run, it makes the currency weaker. To buy the gold and silver they need, banks will have to sell dollars and treasuries. This puts massive downward pressure on the dollar. As gold and silver revalue higher to meet the new Tier 1 standards, the purchasing power of the fiat currency holding them up must fall. The revaluation of gold is the devaluation of the dollar. If you hold an unallocated silver account at a bank, this rule is a danger to you. The bank is incentivized to close your account or convert it to cash, because holding your unallocated silver is now a liability for them. We expect to see banks sending letters to clients saying, "We are discontinuing our precious metals program. Here is a check." You will not hear about the net stable funding ratio or Basel Three on the nightly news. It is too technical, too boring for them. But it is the plumbing of the financial system. The media will talk about market volatility, but they won't tell you the root cause. The root cause is a fundamental change in how banks are allowed to leverage paper assets. The era of infinite leverage ended last night. This is as significant as Nixon closing the gold window in 1971. Now, you need to understand that this move is not an accident. It is a calculated restructuring of the entire system. It is a slow, bureaucratic return to a gold standard disguised as banking regulation. The central bankers know the debt is unsustainable. They are preparing the lifeboats, and the lifeboats are made of gold and silver. With the banks stepping back from manipulation due to these new costs, true price discovery can finally happen. We might see extreme volatility in the short term as the paper shorts cover their positions, but the long-term trend is set in stone. The price must rise to a level where physical supply meets physical demand without the interference of paper dilution. That price is significantly higher than $85. Because banks have to hold more capital, they will lend less money. This rule change will trigger a credit crunch in the general economy. It will be harder to get a mortgage or business loan starting Monday. This deflationary pressure in the economy will be met with inflationary printing by the Fed, creating stagflation. In a stagflationary environment, silver is the single best performing asset class. The smart move is to align yourself with the banks. If the banks are being forced to hold physical metal, you should hold physical metal. If the banks are exiting paper contracts, you should exit paper contracts. Do not bet against the new rules. The wind is blowing towards tangible assets. They passed it. The rules have changed. Monday morning marks the start of the Basel Three era. The banks are scrambling to comply. The shorts are covering and the physical market is tightening. This is not a conspiracy theory. It is a regulatory reset. The paper game is over. The physical game has begun. And to truly understand the gravity of this moment, we have to look back at the patterns of history, because history does not repeat itself, but it certainly rhymes. In 1933, the government confiscated gold to revalue it. In 1971, they abandoned gold to print unlimited money. Now, in 2026, with the full implementation of Basel Three, they are remonetizing gold to save the system from itself. Every single time the rules change at this level, there is a massive transfer of wealth. The people who held paper assets lost everything. The people who held physical metal preserved their purchasing power and their dignity. This rule change is the loudest signal yet that the cycle is turning again. The system is effectively admitting that fiat currency has failed as a store of value, and they are retreating to the safety of hard assets. Why are they doing this now? Because inflation is sticky, and it is structural. The central banks know they cannot get inflation back down to 2% without crashing the entire global economy. So, they are quietly changing the definition of what constitutes a safe asset. By making gold and silver Tier 1 capital, they are creating a new anchor for the financial system that can withstand a decade of high inflation. They are preparing for a future of high prices. If the biggest banks in the world are hedging against inflation with physical metal, you should be doing the exact same thing. For 40 years, U.S. Treasury bonds were sold to you as the ultimate safe haven. Your financial advisor probably told you that bonds are risk-free. But Basel III challenges this entire 60-40 portfolio philosophy. By elevating gold to the same status as bonds, the global regulators are admitting that bonds, which lose value when interest rates rise, are no longer the only risk-free asset in town. This is going to cause a secular shift of capital out of the bond market and into the metals market. We are talking about trillions of dollars that will rotate. The bond market is massive compared to the precious metals market. Even a 1% shift of capital from the bond market into silver would double or triple the price of silver overnight. You have heard people talk about the global reset for years. Well, this is it. It isn't a single catastrophic event like a movie. It is a series of boring rule changes that rewrite the laws of wealth. Basel III is a key pillar of this reset. It reestablishes gold as the center of the financial solar system. This moves us away from a U.S.-centric dollar system to a neutral asset-backed system. This levels the playing field for countries like China and Russia, who have been accumulating massive metal reserves for this very moment. The West is conceding economic ground to the East through regulation. The document is signed. The rule is active. The banks are moving. The window to front-run this regulatory shift is closing fast. Once the full weight of the banking sector enters the physical market, the retail investor will be priced out completely. Do not wait for the 6 o'clock news to tell you what to do. The news is written by the people who want to buy your silver cheap. Look at the rules they passed. They passed them for a reason. Follow the money, not the rhetoric. Buy what the banks are buying, not what they are selling. This is the calm before the storm. Before I go, I'm curious, how many of you are already holding physical metal? Put a yes in the comments so we can see how strong this community really is. Monday is not just another trading day. It is the beginning of a new era where physical reality overtakes paper illusions. Protect yourself. Protect your family. Secure your wealth in the only money that has survived every banking crisis in history.